Okay. Good evening, good morning, and good afternoon, depending on where you are tonight. I would like to welcome you to another webinar from the Gerhard Center. Sustainability reporting is going mainstream in capital markets by our speaker, Professor Robert Eccles. And my name is Ahmed Abdelmajid. I'm an associate professor of accounting at the AUC School of Business. Now, this topic is really a hot topic. There's a lot of hype in recent years about environmental, social, and governance issues, sustainable development goals, sustainability reporting by both companies and countries. And companies are now much interested in this area. One force to reckon with, of course, is the capital markets that would persuade certain companies to be committed to such areas and such issues. Accordingly, there has been a lot of development in terms of sustainability reporting. In Egypt, for example, here a recently mandated framework, which is the mandatory reporting of ESG issues and areas based on a checklist, and this was issued by the Financial Regulatory Authority, and this will come into effect as early as 2022. With the capital markets in play, other issues would arise: the degree of commitment of companies, the degree of authentic reporting, and how to avoid an ESG greenwashing. So today we're going to hear about these topics and other interesting issues from our speaker. Professor Robert Eccles is a leading authority on corporate purpose and the integration of environmental, social, and governance, ESG, factors in resource allocation decisions by companies and investors. He is also the world's foremost academic expert on integrated reporting. Currently, Eccles is a visiting professor of management practice at the Said Business School, University of Oxford, where he's engaged in a number of research projects focused on corporate purpose, corporate reporting, engagement and stewardship, and private equity. Eccles has been a visiting lecturer at MIT Sloan School of Management and was a Berkeley Social Impact Fellow at the Haas School of Business, University of California, Berkeley. He was also a professor at Harvard Business School and received tenure in 1989. Professor Eccles, welcome.
So Ahmed, thank you. I'm for some reason I seem to have control to admit people into the room. So
yeah, me too.
So I'm admitting people into the room. So you guys in Cairo. I've never been to Cairo, but you know what I've concluded is that you must have some ancient Egyptian magic and have a crystal ball that you can see the future, because you scheduled this quite a long time ago when Ali and I started talking, and the title is Sustainability Reporting is Going Mainstream in the Capital Markets. You couldn't have scheduled this better, because today, I'll give you the punchline and we'll work our way up to it. Today at COP26, the IFRS Foundation announced the formation of what they're calling the International Sustainability Standards Board, which will sit alongside the International Accounting Standards Board. And it will basically do for sustainability reporting what the International Accounting Standards Board does for financial reporting. Now, most of the world uses what's called International Financial Reporting Standards. You're an accounting professor, Ahmed, so you would know this. Typical US exceptionalism. We have to have our own US GAAP, and they're pretty much the same. And there was efforts to reconcile them under the Norwalk Agreement, and it didn't happen, but we won't go down that rabbit hole. This is a big deal. I mean, this is a huge deal. If you look at standards for financial reporting, we take those for granted in the capital markets. We wouldn't have the capital markets today if we didn't have accounting standards. So there's apples to apples comparisons. You can look at revenues for a company in, different countries, compare them within an industry. If we didn't have accounting standards, and if companies weren't required to report on it. If you look in the United States, We didn't have that until the SEC was formed. And the way that came about is that there was the stock market crash and the Great Depression. And the government said, well, I didn't work out all that well. So the Securities and Exchange Commission was formed to protect investors through transparency. Because before that time, listed companies didn't have to report. A lot of them didn't report revenues. It was like, oh my God, if I report my revenues, my competitors are going to know and the sky will fall. There was a gazillion little accounting firms. They all had their own accounting standards, their own auditing standards. So you didn't have any apples to apples comparisons, even if they were being reported. And so the SEC formed, and there's a long story about how it happened. I won't get into the details. And it was quite controversial because the accounting firms said, look, this is as much art as it is science. You can't have standards for this kind of stuff. I mean, we understand our situations and our clients, and companies said, our situation is unique. How can you apply a standard to us? And companies still complain about their being unique, and they report non-GAAP earnings and all this kind of stuff. But at least we got to a common set of standards as a baseline, and then people can make their own adjustments and they can do their own calculations. And what I always like to say is that standards are a social construct. These aren't derived from the laws of physics. Just people came together and said, this is how we're going to agree upon. We're going to do revenue recognition. This is how we're going to do depreciation. And that becomes sort of the reality, the felt reality of how it works. And companies report it, investors use it, and it's never perfect, and people complain. So let me go back in history a little bit, because 30 years ago, and this is kind of the personal part, 30 years ago, I published an article in the Harvard Business Review called the Performance Measurement Manifesto. This was in 1991. And the thesis of the piece was that, I'll admit, the thesis of the piece was that, and it came out of some interviews I was doing for a course I was working on, that companies, should start measuring non-financial information. A year later, Bob Kaplan published, much better known article, The Balanced Scorecard. But it was the same thing, right? And it's like, the financial stuff's important, but there's things around human capital and social issues. Environment wasn't talked about as much then, that are sort of leading indicators. And so, I published that article, and I had a little paragraph in there that maybe at some point companies might start reporting on this, because right before I published this article, I'd written a book on investment banks, which is what I did as an associate professor before I got tenure. So I kind of had that view into the capital markets, but I had a view that was different from a lot of people in the capital markets, because my PhD is in sociology. So I had this institutional perspective. It wasn't a finance professor, or accounting professor, an investment professional, anything like that. So I published that article, and because I'd done this book on investment banks and how they work, I thought, gee, I wonder how people in the markets think about this so-called non-financial information. And I went and did a survey of companies and sell-side analysts and people on the buy side. And it was a very simplistic survey, but no one had done it before. There was about 10 items, kind of broadly speaking, and intellectual capital and human capital and social stuff and some environmental things. And the findings were, the market said, we think this stuff is important. We don't think we're getting much information from the companies. The company said, we think it's important. We admit we're not reporting on this very much. And one of the reasons is that we really don't have the systems to do it. So that was in 1995. And this was at that point kind of lunatic fringe activity, right? Nobody was really thinking about it. In 1997, the Global Reporting Initiative was formed by some friends of mine, and I think most people are familiar with GRI. And what they did, I think, was really quite monumental. And the people who started it are friends of mine, and their view was, look, people that are investors, they've got groups like, the ISB, they've got groups like, the Financial Accounting Standards Board to provide them the information that they want, but no one's speaking for civil society. So there's things that companies do that create negative externalities in the world. There's positive ones as well, but I think they were more concerned about negative externalities. And so they said, we think companies should report on those. And they defined, and this is an important point, they defined materiality differently than the accounting standard setting organizations do, or the Sustainability Accounting Standards Board, which I'll come to in a bit. They basically defined it as, a company's activities that have an impact on the world. So for them, the definition of materiality was really that of an externality. So they were formed, and they had, a few companies doing it. And then, the curve kind of went like this. And today, I think there's 8,000 or 9,000 companies. using the GRI guidelines to varying extents, and for the most part on a voluntary basis. There's a few jurisdictions where, they require GRI guidelines. I think SOEs do in Sweden and stuff like that. So I think it was a monumental contribution because it started to focus companies on, this was long before we talked about stakeholder capitalism and inclusive capitalism, but they got companies to understand that, there were things that they were doing that other people cared about other than shareholders. Now, the way it emerged, and they didn't really involve investors, and they said they had a reason for it. And again, it's complicated. I won't get into it, but it tended to be quite a separate function from what was going on in finance. So you had the finance people producing their numbers, and they'd report that to the investors, and they'd talk to the portfolio managers. And you had a CSR department, and it was typically called then. They were reporting on the GRI guidelines. And that was more for civil society as represented by NGOs. That was in 1997. And then in 2000, CDP was formed, the Carbon Disclosure Project. And what they did was they said, look, environmental stuff is important. And they said, we're going to try and exert some pressure on companies by having them initially report on a voluntary basis, what they're doing in terms of climate. And they motivated this by a letter they got from a bunch of institutional investors. So they're formed in 2000. And then in 2007, they became the secretariat for something called the Climate Disclosure Standards Board. And the language was very carefully chosen to sort of mimic International Accounting Standards Board, Financial Accounting Standards Board, using the greenhouse gas protocol. There was some of the initial work that was done to try and get to a standard around reporting on climate. So I think that was another sort of, step along the way. And if you look at then what's happening in 2000, you're starting to see infrastructure being created to provide a better framework for reporting on sustainability or non-financial issues than we had before. I published a book in 1999 called The Value Reporting Revolution, Moving Beyond the Earnings Game, with some people at PricewaterhouseCoopers. And, I don't think people paid that much attention to it because the internet was booming and everything was great. And so the markets were going up like crazy. Then they all crashed. The internet bubble burst. You had all these accounting scandals. Enron and WorldCom published another book called Building Public Trust with Sam DiPiazza, who was the global CEO of PwC. We said, we need a three-tier model. You need to have kind of global GAAP. So let's converge basically IFRS and US GAAP, which didn't happen, as I said. And then you'd have industry-specific standards because things that are important for investors in a bank aren't the same things as a pharmaceutical company and oil and gas company. And then admittedly, there will be things that would be very specific to a company based on its purpose or its particular strategy. So we published that book. And then that also kind of got overwhelmed by events because in the United States, Sarbanes-Oxley got passed with, 404. So everybody was focused on just making sure that the internal control and measurement systems that now the CEO and the CFO had to sign off on were buttoned up enough for corporate reporting so you didn't have fraud on financial reporting. And it's important to recognize that, decades and decades of working on standards and, auditing requirements, fraud still happen. So it's never a perfect world. So, but at least in 2000, you're starting to say we need to make sure we've got quality financial reporting. GRI is continuing to motor along. You've got CDP and CDSB is formed. And then in 2010, the International Integrated Reporting Council was formed. And I was involved in that. And again, there's a long story that had to do with my first book that I did with Mike Cruz on integrated reporting called the Integrating Reporting Movement. I know that was the second one. So, and it was interesting because I didn't come up with this idea. I was looking into reporting and people were telling me about Natura in Brazil that started doing integrated reporting in, I think, 2004, and Novo Nordisk, same year, pharmaceutical company in Denmark. And the reasons were the same. So I thought, this is interesting. In practice, you see, and they were calling it integrated reporting. And you had the Prince of Wales Accounting for Sustainability project that had started something on interconnected reporting. So we all get together, long story short, the International Integrated Reporting Council gets formed, and it was always intended to be a framework, not a set of standards, just like TCFD is a framework. It's not a set of standards. 2013, they published their framework. It's the 6 capitals people are probably familiar with. Then in 2011, the Sustainability Accounting Standards Board was started. The idea was from my friend Jean Rogers. And she came to me and she said, look, She'd written a very nice paper with Steve Leidenberg and David Wood, at Harvard's initiative for investors. And it was basically kind of the idea that Sam and I had written about in this Building Public Trust. We need to have industry-specific standards for the material issues, which vary by industry. And it was kind of clever what she did, because it wasn't going to require any new regulation in the United States. And the United States sort of got heartburn about regulation, as people know. It was regulation SK says if it's material, you've got to report it. Doesn't have to be financial, doesn't even have to be a number if it's material. Very kind of vague definition of materiality. This piece of information and the total mix of information would matter to a reasonable investor, like, kind of what does all that mean? And a lot of the judgment would then rest with the company to make that determination. So SASB gets started and we start grinding away, eventually ended up with 11 sector classification system that broke into 77 industries, and through quite a rigorous process that involved companies and investors and people that were experts in the industries, eventually overseen by my friend Bob Herz, who's the two-term chairman of the Financial Accounting Standards Board. So he really knows what's involved in creating good standards. SASB gets formed in 2011 and people start picking up on that. There was some initial confusion, which maybe a little bit still remains today, where people said, okay, so GRI, although it had been started in Boston where I live, it had moved to Amsterdam. And, there had been much more pickup in Europe than had been in the United States, was that somehow GRI was for Europe and SASB was for the United States. And that's simply not true. They were organizations setting standards for different audiences, because SASB was saying we define materiality from the perspective of what an investor would care about through enterprise value creation. GRI, as I said, was defining materiality as an externality, something that's being created in the world. And, there was kind of some loggerheads, which typically happens in the NGO world. So it's kind of trundling along. And then you've got the TCFD formed, and I wrote it down here, 2015 framework, focused on climate. And then in 2020, so we're almost at the current day, the EU taxonomy comes out. They're updating their non-financial reporting directive. And it's now called the Corporate Sustainability Reporting Directive, which is going to be passed through legislation in April of next year, last I heard. And you've got the International Business Council, or WEF, who came out with their report on kind of common metrics for stakeholder capitalism. So at that point, what does the world look like? Okay, I guess we've all agreed that reporting on sustainability is important. Big progress from when I started in the early 1990s, right? When everybody thought this was just a nutso thing and irrelevant. But you've got a whole bunch of different organizations that, are trying to contribute to that. For the most part, these are NGOs, or they're kind of, initiatives that don't have any kind of formal government backing, although the TCFD did more because it was under the Financial Stability Board. And you got to the point where people not resisting it, they're saying, well, companies recognizing, more or less, we should be doing this, investors saying they want it, sure would be nice if we could agree upon what those standards are. We don't have to argue about standards for financial information. It would be great if we could do that for the sustainability reporting. Very important person in this whole game is a woman named Clara Barbie, who was the CEO of the Impact Management Project. I saw her online today because she's working with the ISSB to get that started. So what she did was corral all of these different organizations together. And three things happened in September of last year. They published a report signed off by, CDP and CDSB and SASB and GRI and IBC-WEF saying, here's kind of a common framework, comprehensive framework. IBC-WEF had their report. And then out of the blue to me, the IFRS Foundation, publishes a consultation to establish what they're calling the International Sustainability Standards Board. And I had talked to some people there, just a couple of years before for a paper I was writing with my colleague, Richard Barker, and it was clearly not on their agenda at the time, but things had clearly changed. So they do a consultation. The letters are due at the end of December. Broad support from the investment community saying, yes, standards would be good. The big debate and the continuing debate is around the definition of materiality. So these standards are going to be based on what matters to investors, or is it going to be a broader definition? These are going to be based on a definition of materiality that also includes externalities. The EU is taking a somewhat different tack on that through the Corporate Sustainability Reporting Directive. And if you look at what EFRAG, the European Financial Reporting Advisory Group that advises the EU, is working with GRI, they're going to come up and in their legislation, they will recommend, I think, a longer list of things for companies to report on, and not recommend it. The state they can just mandate and say you do it. The ISSB, the International Sustainability Standards Board, would be the global baseline. And then you've got the usual complexities in the United States because of political polarization. And I won't get into all that, although it drives me nuts. Well, there was some high level guidance on human capital reporting last year, and now they'll be on climate disclosures, I'm hoping by the end of the year. So that's good progress. But you still have a whole lot of organizations that are separate, even though they're trying to kind of play nice with each other, more than they have historically. So what happened today, which I think is such a big deal, and this is what Ahmed and Ali, like I said, your timing was brilliant, man. I mean, you couldn't have done this better to have something, kind of sustainability reporting is going mainstream in the capital markets. It was announced today that the International Sustainability Standards Board is consolidating what's called now the Value Reporting Foundation. So there'd been a merger between the Sustainability Accounting Standards Board and the International Integrated Reporting Council, which are kind of both my children, and they got married to each other. So that's a little weird, but we'll let that go. So that kind of happened. That was good. And so now what you have is there was the merger between SASB and the IRC to form the Value Reporting Foundation, along with the Climate Disclosure Standards Board. So this is really a big deal now because of a couple of things. Number one, the IP, the people that have the knowledge and the skills to do this. The International Sustainability Standards Board is not starting from a clean sheet of paper. I mean, they've got funding. They came out by the end of the year for consultation. They're going to have a consultation on climate, on kind of a general comprehensive kind of framework of what, kind of how they're thinking about how sustainability reporting will be done on different metrics. And it's gone from simply being a set of well-meaning, typically underfunded, hardworking NGOs to the main body in the world that has got credibility for setting standards. And now they're going to have this parallel body, the International Sustainability Standards Board, work with the ISB, because clearly these things aren't completely separate. I think you get to true integrated reporting. As I said, there is this tension with the EU, and what you saw in the consultation, one of the biggest themes was people saying they should do so-called double materiality. And kind of there's people kind of in the much more progressive wing that are really disappointed that the International Sustainability Standards Board said, we're just going to kind of focus on those things that matter to investors. They're going to no, they should focus on everything. And I'm like, I understand why you feel that way, but I don't agree. What their skills are, what their remit is information for investors. They can coordinate with the EU. They can coordinate with EFRAG and the GRI. Excuse me, because there's this notion of dynamic materiality. It's not one or the other. Things that may not be material to investors today become so over time. We've seen that happen with climate change. We're seeing that happen with DE&I. You're seeing that happen with income inequality. And so what was announced today, to me, is as big a deal. And it kind of gets lost in the shuffle of everything else at COP with, 130 trillion is going to be committed and $100 billion from the developing countries. And I'm not demeaning any of that, but you can have all of this capital moving. And unless you've got clear standards for how companies can report on whether they're achieving these goals or not, that are going to be credible and they're going to be comparable and they're going to be auditable, it's going to be very hard to know whether or not people are meeting these commitments. Standards aren't targets. You can't confuse those. Standard setters don't say, you should commit to net zero by 2050 or 2030, and here's what the plan should be. All they say, whatever you've committed to and you're reporting on, we have a set of standards that is going to enable the investors and the other people who are looking at this information to say, it's as credible and it's believable as what your revenue numbers are and your profit numbers are and what your assets and your liabilities are on the balance sheet. So it's a Herculean effort. Kudos to all of those people that were involved. Great leadership from the trustees of the IFRS Foundation. I'm optimistic that US companies, whatever happens with the SEC, will say, look, we compete in a global marketplace. We've got a global set of investors. Investors, they invest globally. They want a set of standards. And so, it'll never be perfect. There's going to be sort of, bumps along the road, but I think, they're going to have that up for consultation. I think by the third or fourth quarter, what they were talking about this morning at COP is we'll have a standard on climate. They'll quickly move into other environmental issues and social issues. And so 5, certainly 10 years from now, imagine that we have for sustainability reporting, which has been a primarily kind of NGO driven, more kind of in the CSR part of a company, where CFOs in the quarterly calls and the investor meetings are reporting on their sustainability performance along with their financial performance and how they're related to each other. And we have the same kind of credible, reliable, quality information for sustainability reporting coming out of the body that sets the standards. They can't mandate the standards. That's up to countries and jurisdictions. So Egypt will decide if it wants to sort of sign up for the ISSB standards or not. And I'm guessing they probably will, from Ahmed, what you were saying is already happening. This is a big deal. So it's like, as I said, in the United States, we didn't have standards and reporting requirements for financial reporting until the SEC was formed. We now have the opportunity to create that same kind of quality information for sustainability reporting, too excited, as we've got for financial reporting. It'll be complicated. Standard setting is always complicated. You've got very different cultures from the IFRS Foundation and these different NGOs. But to me, I know this is a kind of down in the weeds sort of plumbing in the capital markets. I think this couldn't be a more exciting day. So once again, Ahmed, Ali, brilliant timing, guys, brilliant timing. So said I talked for 30 minutes, so let me end it there.
Oh, thank you very much, Professor Eccles. As a moderator, I get to ask the first question, I guess. And then we'll take the questions from the audience. So with all this reporting, that definitely will channel the efforts of companies in the areas of ESGs and these very important topics. But I would like to get your insight on certain companies that the design of their business model is not very sustainable by design, or they're producing harmful products, for example. And that there's a long debate, in the literature, these sinful industries, I guess, that by design pollute, the industry or pollute the environment, or design are harmful to the health of consumers. At the same time, you get them, they're reporting on, their ESG activities and the like. So get your thoughts on that, please.
So there's sort of a couple of embedded questions in there. So let me try and peel them apart and see if I'm answering it. You can add to it. You can have a company. Let's take an oil company, and they can be producing all kinds of negative externalities, as we know. And in many ways, they could have pretty good ESG performance, right? On the carbon emissions, it wouldn't be, necessarily good, but they could have quality corporate governance. They could have an independent board. It could be a diverse board. It's knowledgeable about the industry, which wasn't true about ExxonMobil, and maybe we can come to them later. They could be very safe in terms of the oil wells, and people don't die on the oil rigs, and they don't pollute the oceans. So you get into this difference between kind of ESG as the operations and activities of companies, and I'll give you a very dramatic example in a second, compared again to the externalities that are being created. So, you've got carbon externalities from an oil and gas company, particularly Scope 3 and how it's being used. A very controversial industry is tobacco, because there's not really anything good you can say about cigarettes, because they just kill people. Oil and gas at least heats our homes and gives us air conditioning and stuff. So I'm an advisor to Philip Morris International, which I know shocks some people, which is a tobacco company. But what they're doing is they've got a business transformation to create a smoke-free future through reduced risk products, and then eventually not to deliver nicotine at all. Because what kills people is the burning of the tobacco. What they're addicted to is the nicotine. And their view was that the most material issue is the harmfulness of our product. So they didn't publish a sustainability report until they had a strategy for dealing with that externality. And now they do integrated reporting. They've got a statement of purpose. So I think what we're looking at, if you generalize this, it's not going to be enough for companies that have got business models that need to transform to have good ESG performance in terms of operations and activities, particularly starting with carbon. If they are high emitting companies, they're going to be under pressure because we're now going to know just exactly what the carbon emissions are from what they're doing, that they're going to have to transform their business models. And you're seeing that happen very dramatically in oil and gas. You're seeing it through investors, through the Engine #1 campaign, on ExxonMobil. You're seeing it through the courts where, in The Hague, there was that decision, that Shell had to speed up its carbon emissions. And so it's important to, again, not confound, just like you can't confound targets and ESG standards, you can't confound having a set of standards and then sort of what the business model is. The information that's being reported will give investors the kind of ammunition that they need to pressure companies if they choose to do so. But they're going to have to do that through pretty active engagement, which is what Engine #1 was doing. And so I think what you're seeing in the case of the EU and why they've got this more emphasis on double materiality is with just kind of traditional ESG, you can have pretty good scores as long as you're not kind of violating any laws, but that's not enough. You need to make sure that you're looking at what the impact of the company is on the world as a whole, and then that gets you into this kind of impact and double materiality thing, which, as I said, the ISSB, is not dealing with now, and properly so, but that doesn't mean that other people shouldn't be thinking about it. And eventually those things, and if you look at the ISSB, what's interesting, and you look at the TCFD, so my guess what's going to happen at the ISSB, the TCFD is going to be the framework, the basis of the framework, generalized beyond climate. The industry-specific stuff will come from SASB. But if you look at regulations, even in the United States, whether it kind of would look from a short-term sense to be material or not, from a universal owner perspective, all of the carbon in the atmosphere adds up. So, every company, and I think it should be private as well as public companies, will have to report on carbon. And there's a lot of interesting things going on in private equity, but it's probably subject for a different day.
Thank you very much. I have questions from the audience. I think Mr. Amr.
Unmute. Can you hear me right now?
Yes.
Yeah.
Okay, perfect. Thanks, Robert, for a great talk. Thanks, Ahmed, for the time for it. I teach ESG at the University of Waterloo, and I have two questions for Robert. The first one is like the term ESG itself, because ESG as a term has been there since 2005 when the IFC had their report, Those Who Cares Wins. But like the hype started when like Larry Fink had the open letter to the CEOs, like I'm from BlackRock. So, okay, I'll start my video. So the hype was there, like kind of when Larry Fink in 2020 had his letter to the CEOs to start reporting on ESG. That's when the term ESG was there. But right now, are we moving from an ESG hype to a comprehensive reporting based on the IFRS, since they work in 160 jurisdictions? So that's like kind of, I want to get your thoughts about the terminologies of where the future is going from ESG into comprehensive reporting based on the IFRS recommendations. And the second question, like related to the dynamic materiality and double materiality, because even in the letter of like kind of intent to collaborate together, there's no clear definition of like kind of materiality. And there's a lot of lack of clarity on how the EU taxonomy or the IFRS would come and step in and say, these are the right standards. Even the response letters from both the GRI and SASB, or right now the Value Foundation, each of them is competing on, we are the right standards, you have like kind of to follow our like kind of protocols and our client base. So it's going to be a hub and on a buzz, or there's like really standardization that we're seeing soon in the future. Thank you.
So those are both good questions. I think that the first one is a little bit easier to answer than the second one. And the second one is probably the more fundamental one. So let me just kind of deal with the first one. And what Larry was talking about in the beginning was kind of companies should have a purpose, and it was all pretty high level. And what does that mean? Then he clarified a little bit. And then he started, I think, a couple of years later saying companies report on SASB and TCFD, and we're going to look at that in the portfolio. I think the signaling was good, that it's like, here's a major investor, the largest asset manager in the world. sort of indicating that they think they should be doing it. But what makes it real is having an international sustainability standards board, where it's like, okay, SASB, GRI, you've been knocking your heads against each other for all these years, and I experienced it a lot personally. Just like, as I said, with financial standards, reporting standards, we're going to have this in the ISB. So I think then it becomes real. But these are still social constructs, right? There will be sort of technical debates around the right way to report on carbon, and everybody will have a different opinion. Eventually, we'll settle on one. The situation between the EU and the ISSB, I think, is a very complicated one. And it's not something that the ISSB really controls. So, what I've seen and what I hear is that in the background, it's become more collaborative than it felt like it was in the beginning. It felt to me that kind of, FRAG was attempting to sort of get a jump on the ball and was moving very quickly. And, the ISSB was moving more slowly because of the process that they've got. And so they were going to kind of get the jump on it. I think the way to think about it is that, let's say there's 3 jurisdictions, and the ISSB is not really a jurisdiction, but there's like 3 lists of standards. There's the really long one that's got, let's say, 20, from the EU, from the CSRD. And then there's like a shorter one that maybe has 8, let's say, from the ISSB. And then there's, if we're lucky, 1 or 2 from the US. Whatever is common to all 3 of those, let's take carbon, greenhouse gas emissions. If it's the same metric, the same calculation, that's really good, because then you do have what's being called a global baseline. I think the EU ISSB thing is the ISSB says, look, we're the global baseline. This is going to be what investors care about. The EU says, okay, we're going to synchronize with you on what the global baseline is. We're going to top it up from the double materiality notion. And, eventually over time, maybe those get then incorporated into the standard setting process. You're right that the letters were quite different from SASB and GRI. I mean, and the GRI thinks it should be our way, and SASB thinks it should be our way. And so it's in the end, it's a political process. And I think one thing we need to be careful of, we haven't talked about it so far, is look, reporting can only do so much. And my concern about huge emphasis on double materiality is to think that reporting is going to be by itself enough to change behavior. And I think you really need, sort of the fundamental question here is corporate form and what company law says about fiduciary duty. So in US parlance, we've got the Delaware Corp and we've got public benefit corporations. And I think if you really look at the role of the corporation in society, if I was to wave a magic wand, I'd say companies should be public benefit corporations where you've got a positive duty that you've declared to some set of stakeholders, and shareholders will hold the board accountable for that, just like they're held accountable for financial performance. With that corporate form and company law, that changes the definition of fiduciary duty. Then you'd have to deal with fiduciary duty on the investor side. And that's also a very political and ideological issue when you look at it in the United States. And then, the reporting requirements kind of follow. So don't throw out the baby with the bathwater. Just starting with the ISSB is good. And what I'm hoping is that the EU says, we're good with the ISSB as the baseline. We're the EU, we can kind of top it up to the extent we want to, that there is a mechanism, and I know they're working on it, where you can kind of have a sort of ongoing consultation and dialogue between the ISSB and the EU, so that there's some, at least kind of a path to which issues that are covered in the EU taxonomy CSRD that aren't in the ISSB, when the determination is made that investors think it's material for their point of view, they incorporate it. And to further complicate things, materiality, sort of the definition, what is that means? It kind of varies to investors. If you're a pretty small investor and you have a small portfolio, you're an active manager, then you can take the sort of single materiality definition. If you look at the really big asset owners and asset managers that are universal owners, their view is like, man, I'm not chasing alpha. I just want to get a decent beta. If the world's going to hell because of climate change and income inequality, I'm not going to get that. So what their band of materiality would be broader, than for a much smaller asset manager that can kind of pick and choose among stocks. They're saying, look, this is why you see climate disclosures and income inequality is the one that always comes up again for the universal owners. And there's a very interesting project called the Shareholder Commons. If you don't know about it, look them up. They'll be weighing in, and that'll be a source of pressures around, because since that's the investor voice, if enough of them are saying these things that under a more traditional approach to materiality wouldn't be considered material, they are to us because we're thinking at the system level rather than the portfolio level, then I think that'll be a mechanism by which some of these right now double materiality issues would fall under the work of the ISSB. But, from an implementation point of view, the second question, you're exactly right. So you've got the culture issue of these organizations coming together, as I said. And then you're relying upon sort of a very multilateral group, which is the IFRS Foundation in all these countries, and the EU. And then there's politics within the EU. The French think they should be in charge of everything, and blah 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 blah. And as an American, I'll never understand how things work in the EU. I can barely understand how things are working here because they're such a mess. So we're kind of depending upon the goodwill of the people involved. But what's common across all these different standards is, a big set of multinational companies that would like to have a clear set of rules to play by, and, a relatively small set. When you look at the asset management industry, the top 5 have something like 20% of assets under management, and the top 10 have like a third or something. So there's a lot of concentrated influence in the asset management community that if they speak with one voice, they can make a big difference in terms of getting some, at least good coordination between these different standard setting efforts. But to be determined, right? We'll kind of see. But hey, Ahmed, maybe because you guys predicted the event today.
Maybe.
So you got to schedule another one of these things for 2 years from now, and we'll know the answer to Amir's question.
Yes, exactly. Thank you, Robert. Thank you, Amir, for your question. I think we have another question from Vinette.
It was a wonderful presentation.
I can't, Vinette, sorry, I can't hear you.
Vinette?
Standards like GRI and ISS, good on paper. So in real implementation, it gets very complex.
Vinette, I'm sorry, the voice is not clear.
Well, in fact, I was talking about the standards, the ISSB standards and the GRI standards. So, in fact, they look very good on paper, but as far as the implementation is concerned, they basically do not, basically, in fact, I have to. Okay.
I think
very good on paper, but as far as the implementation is concerned, they are not able to serve the purpose. For example, on the supply chain issue, for example, on the climate financing issue, we see that these standards basically don't work because every country has got its own. Advanced countries have gotten very, very sophisticated system. But the developing world is not able to do its work. For example, the standards, for example, in developed world, for example, like in Switzerland, Sweden, are going to be a lot more different as compared to what exactly they will be followed by, for example, in developing countries like emerging countries like China, etc., where the labor standards, where the manufacturing and where the supply chains are not that well developed to meet those standards. For even in the climate financing side, also we see that some of the large companies like Shell, etc., are basically producing the vehicles for the fossil fuels, but at the same time are also developing working for the renewables. So there is a lot of greenwashing thing is going on. So we have to how can we make this work in a very synchronized way so that these things basically do not, basically overlap, and both advanced countries and both the emerging countries can work in the one direction, because even with the stock, because it seems as if the profits on the stock markets are basically it is for the stock markets and for the profits, etc., and for the large billionaires capital owners, but the small firms and basically are left behind, and so basically we are not able to see the things moving in the right direction at this point of time. So how do we see that this thing like standards, which are at this present moment at a very nascent stage at this point of time, are able to match the goals globally, so that we are able to work for the globalized world, rather than just at this point of time just for regions and for very simple blocks and for big summits like these COP26. Thanks very much. Thanks.
Thank you, Robert.
So I didn't, kind of catch all of that in the beginning. Let me try and unpack it a little bit.
I think Vinette, I mean, the audio was not that clear at the beginning, but I think he's referring that that are these standards quite universal, that they're applicable to both developing countries and developed countries.
So I think the answer to that is yes. I mean, what I picked up from what I was saying, I think we've got to be careful that we don't. It gets back to what I was saying earlier. You can only don't expect too much from standards. So I think you come up with a standard for how you report on greenhouse gas emissions. I don't think take an oil company to pick an example. I don't think it really matters what country it's in. Greenhouse gas emissions are greenhouse gas emissions. So I think the standard would apply. There's a question around having the systems to be able to do that in a credible way. People say, can smaller companies, afford to do this? And I think that's a fair question, but I don't think that's what Vinette was asking about. The issue there is, yes, you can have different standards of conduct in terms of what, quote, a good supply chain is, or what the expectations are around, how much carbon you should be emitting. Those are separate from setting a set of standards. You could have a set of standards around supply chain somehow, and human capital, and come up with that. What would be acceptable practice to companies in different countries or investors in different countries, I think is a separate question from the standard for reporting. So I think you need to distinguish between kind of standards of practice and standards of what are considered best practice or, good conduct, and then kind of the standards for the metric R's of what you're reporting on that. So, Ahmed, any other questions? You're on mute.
That's okay. Other questions from the audience? So let me ask you a question about, so we're talking about the reporting standards themselves. Do you expect that these standards also will be reflected in auditing standards? So the external auditor, will they have to be now, equipped to audit financial statements or reports with such issues?
So, that's been discussed, and I think eventually that's going to happen. And again, it's going to be up to countries to decide whether they want to have them audited or not. So you can't, and auditing standards and reporting standards are different, Ahmed, as you know. But, what my friends in the accounting firms will say is, to have an audit process, we need to have a standard as a baseline. So, you come up with that. And then once you've got a standard, you can say, here's what the audit process is to determine whether or not the standard was fulfilled. So I think you will end up with, kind of so-called positive assurance once you've got a standard on, say, greenhouse gas emissions. The other thing that, is, and I've written about this a little bit, there's a question about whether or not today the financial statements, just the financial statements, whether the audits are taking account of climate issues in the financial statements, because to prepare those, you need to create scenarios, you need to make projections. And there was a very interesting study that came out about a month ago from Carbon Tracker, where they looked at 107 companies to see if, make an assessment as to what, to the extent to which they thought that the financial audit took account of climate change. And for the most part, they didn't think they did a very good job. When I talked to people in the big four firms, they say for us to really be able to do a quality job incorporating climate change in the financial audit, in things like, the assets and the liabilities. Do we have stranded assets? Is it a going concern? We need to have a standard around how they're reporting on carbon, and then we look at what scenarios are that they're presenting. If they're making commitments to say to be net zero by 2050, are those then consistent with, kind of how we're working with management, and how management, which ultimately is responsible for the accounts, kind of what those numbers are. So, but the short answer is, I think you need to get to the stage until you have positive assurance on, the sustainability information, like you do with financial information. It's going to remain a second-class citizen, and it's going to be costly. You're going to need to improve the internal control systems. You need to have better software. I'm involved with, a startup company called Persephone on carbon. There's others, maybe the big ERP vendors will get into it. So you'll need to make an investment in the internal control and measurement systems. You're going to have to pay more, but it's ultimately investors who pay for the audits in theory, if you're going to have positive assurance. But that's the only way you're going to put the sustainability and the financial information on par, so that you've got true integrated reporting.
Thank you, Robert. I think there's a question from Dr. Angie Zahir. Angie?
Yes, hi, good evening.
Hi, how are you?
Thank you so much for this webinar. It's definitely a very interesting topic, and like you have kindly stated, it's definitely the right time for such topic to be addressed. And thank you for that, Ahmed, and for the Gerhardt Center for doing so. And I just have from a researcher point of view, I teach at the American University in Cairo with Ahmed, and also in the accounting field. And I'm interested to ask the question: what type of questions as a researcher should we tackle to help the regulators bring this, to become more of an informative to the investors, and to be more of a use to also the auditors as well? Because I understand for the auditors' point of view, this brings on more burden on their task as well, and more responsibilities to in terms of verification. They just had recently some of the recent additions, so this would definitely be I'm not sure if it's going to be a burden more of a burden to them, or more of so I would really like to hear your highlights on this. Thank you.
Gee, there's a lot of interesting research questions, right, that one can do. As you're talking, Angie, so I've got some colleagues at Oxford, and if you write me, Ahmed writes me, I can put you in touch, named Casby Soonawala and Judith Strolla, who are doing a research project on insurance on basically sustainability reports. So I think it would be an interesting thing to see, and I couldn't right off the top of my head frame the research question, but do we see benefits by having better forms of assurance on sustainability reports? And maybe it's more of kind of a qualitative field study, by interviewing investors and stuff. So I think a very important thing to do from a research point of view would be to assess in some fashion the value that investors would place on having positive assurance. Because I said, ultimately, I mean, the company writes the check, but the audits are being done for the benefit of the investors. So I think good research on how much positive assurance is worth to the investment community would be very powerful. I know the SEC is going through this exercise on the cost benefit analysis, if you're going to have some kind of disclosures on carbon. So I think that would be a good place to research. There's been a lot of research. I did a little bit. George Serafin, my colleague at Harvard Business School, has done a lot more. Kind of the big question that always comes up is the relationship between sustainability performance and financial performance. I think once we get standards for climate disclosures, and you get them for enough period of time so you can do a longitudinal study, but you're young enough, you'll still be around, you'll be able to do it. I'm not sure I will be. We'll see what happens. I think that'll be very interesting to kind of see, is the performance better of companies that, have done consistently, have set targets and have met those targets or beat those targets. Is that being rewarded in the capital market? So I think that's a potentially very interesting research domain. And then kind of getting back to some of the previous questions that were asked, and, I'm the question you were asking around ESG, the studies that have been done around ESG is largely ESG as operations and activities, more from a risk perspective, more from single materiality. I think there's a big open question around, does the stock market reward impact? When you get outside kind of whether it's private equity or, very focused companies, renewable energies, where it's clearly an impact play. Like if you look at what's happening with Shell, will the market reward Shell for reducing its greenhouse gas emissions faster than the other companies or not? And if you look at the decision on Shell in the court case, and I've written about that and you can find it, it was very interesting because it was tort law. And, the courts basically said, it's not our concern whether this is going to lose you money or not. As tort law, we represent civil society. And, our view is that the people of the Netherlands are being hurt by the activities of Shell. And so, they issued this ruling and Shell is appealing it. The domain of measuring impact is not as well developed. That's kind of where, the EU is trying to go in the GRI, as we've talked about. True impact measures are complicated because ultimately you're relying upon data, I think, from outside the company, because it's like, outcomes in context. There's a very interesting project you should look into if you don't know about it, called the Impact Weighted Accounts Initiative. I'd write that down, at Harvard under George Serafim and Sir Ronald Cohen. They're working on that. And then there's something largely European called the Value Balancing Alliance. And the guy that's running it is was at BASF named Christian Heller, and Novartis and others involved. So I think this domain of kind of how companies are thinking about reporting on impact and then relating impact to financial performance, I think is another, very promising area for accounting professors to study.
Thank
And
you.
I'm happy to, if you write me, or write Ahmed or something, I can put you in touch with Casby and Judith on the assurance for sustainability reporting.
Thank you very much. Other questions or comments? Okay.
It's late in Cairo. It's late in Cairo. People want to have dinner.
Yeah. No, we're right on time. It's exactly 8. So that's excellent. Thank you very much, Professor Robert Eccles, and thank you very much for the participants and for the Garrett Center. With that, we come to an end to our webinar. And just to remind you of the next webinar of the Garrett Center by Olivier Cassier, The Journey of Multinational Corporations to Inclusive Business, which will be held November 10th at 7 p.m. Cairo time. Once again, thank you very much, and looking forward to